but that's okay. So we did chapter 7. We did all that activity-based costing. Now we're going back to something that I think is actually simpler. So there you go. So let's take a look at the Foundation 15, and let's think through what we got going on here. Now, one of the things that I really do want y'all to think about is simply this. Back in ACC120, when we were in chapter 6, that was the chapter where we introduced the whole thing of merchandising, right? And we had that whole, we added that multi-step income statement. And you have to realize that where we have consistently sat in ACC 121 is we're not a merchandiser, we're a manufacturer, right? And understand that direct materials, direct labor, and direct overhead, none of those ever change. The only thing that we are trying to deal with all these allocations and everything else is all this indirect overhead and trying to figure out accurate costing so we can make decisions. The other thing is that if you notice, we never look at, in 121, we're never looking at the bottom line of the income statement. We never talk about net income, we talk about net operating income. So if you take that all the way back to 120 in chapter 6, right, it was sales minus cost of goods sold equals gross profit. Then we subtracted all the operating expenses and or additional operating operating items in there, and we got to net operating income. So we're only about halfway down the income statement, and that's kind of where we've been living for the last few weeks in 121, because all of that other stuff at the bottom of the income statement, it's just there, okay? So we've been living in these chapters all the way up there at the top of that multi-layered income statement, trying to figure out what is our operating income, the core of our business. Are we making money? And we've been tearing this whole thing apart in multiple ways, trying to figure out how do we make better decisions on if we're making money, are we not, what should we do next? Should we, add a new item? Should we not? Is our gross margin high enough or not? And all those kinds of things, because this is where we start when we're dealing with all these decisions in accounting. Okay, this, I will say, I haven't taught. I told you all this. I haven't taught this class in like 7 years, and the last time I taught it, it was online. This is so much more fun when it's in class, because this is where I love digging into something and just tearing it apart and figuring out, do we do this? Do we not? Right? So if you found this fun, you might be an accountant. If not, then I don't know. Maybe another business option might be good. All right, so let's look at this foundational 15. Okay, we've got Oslo Company prepared the following contribution format income statement based on a sales volume of 1,000 units. The relevant range of production is 500 to 1,500 units. Now again, remember, they've brought back this relevant range idea. Okay, now understand that this relevant range, I don't want you to lose the significance of that. So the relevant range is basically determined based on, effectively, we've got a plant, we got a couple of manufacturing machinery, and how many units can we make? So what is our bottom level production, and what is our top level production without having to build another building or add another piece of machinery? So in this particular case, 1,500 units is the top point where we could max out everything, all the machinery, production equipment that we currently have without having to add additional capital investment. You with me? So don't lose the idea of what this relevant range is actually really about, okay? So when they gave us this information, they gave us just this tiny little piece of the income statement, and they told us that the number of units is 1,000 units. So the first question is what is the contribution margin per unit, right? So when we're sitting here and we're looking at this information right here, and this is what we have, what should we calculate first? Because we've got to fill in some of these yellow blanks here. So what should we calculate first? Okay, so how do we calculate the sales price? So we're talking about that item, that cell right there. So how do we get it? Good. It's just simply sales divided by the number of units, right? So we're obviously selling at $35 per unit. The variable expenses, how do we get that per unit? Good. It's the total variable expenses divided by the number of units, right? And now we just need the difference. We need the difference between the two. So we got to take the 35 minus the 21. So we get $14 contribution margin per unit, and that is the number that we're looking for. So I'm just going to actually hit equals and point to the contribution margin. Okay. Now, when we get to what is the contribution margin ratio, we only have to really go one additional step, but, you know, it'd be nice to just do the whole thing. So remember, the sales per unit, that's always 100%. So it's the top number divided by the top number, okay? Then we've got our cost, our variable cost per percentage compared to the sales. So 60% of our cost is going into the variable expenses, which just simply means that, again, we can take, well, I can't drag and drop it over because that column C is currently in dollars. We need this in percentages. So we can just simply take the 100 minus the 60, and now it'll give us 40%. So our contribution margin ratio is 40%. Now again, don't lose this. So what that contribution margin ratio tells us is if we have one more dollar in sales, we get to use how much? How much? Flip it. We get 40% or 40 cents. So the contribution margin ratio tells us that for every additional dollar that we sell, we get 40 additional cents effectively in our contribution margin that we can start using towards our fixed expenses. Okay? So there's that. Then we've got, what is the variable expense ratio? Well, the variable expense ratio is just simply going to be the other part, and that's the other 60%. Just don't forget to do some simple things like verifying any calculations that you do, because if you don't do these in Excel and you're doing it on your paper, you know, something along the lines of you ended up with 55% for variable expenses and 40% for contribution margin, right? That only adds up to 95. So make sure that you're double checking, you know, your math and everything as you're working through a problem like this. Okay? All right, so then it says, if sales increase to 1,001 units, what would be the increase in net operating income? They're wanting a dollar number. Good, it's the $14, right? So we're still talking about this per unit contribution margin, because this number, the contribution margin, goes up by 14. The fixed expenses, remember, don't lose that. The fixed expenses don't change. Only the variable expenses change. Okay? So if that goes to $14,014, then this goes to $56,14. Okay? All right, how we doing? All right. Then in number 5, it says if sales decline to 900 units, what would be the net operating income? Well, first of all, let's just key in what we've got. The units are 900. Okay? The per unit sales and variable expense per unit, does that change or not change? Good, it doesn't change. So let's, on the sales, let's just come up here and let's pick up our sales of $35 per unit, and let's pick up our $21 per unit. And to get to sales, how do we get to sales? Units times the sales price. So we pick up units times the sales price. If we want variable expenses, we simply pick up units times the variable cost per unit. Now, the other thing is, and this is what's absolutely key, don't read anything into the problem that's not there. What's fixed expenses? Good, the 8,400. It doesn't change, so we can pick up that number there. So our net operating income at that point with 900 units is 4,200. Okay. All right. Now it gets kind of interesting. So then it goes on to say, if the selling price increases by $2 per unit and the sales volume decreases by 100 units, what would be the net operating income? Now, the one thing that you do have to make sure of when you are reading some of these questions, because again, you end up with like all these additional follow-up questions and what if, ideas and all that. Go back, because you might be inclined to look at this next question and go, oh, okay, well, if the sales volume decreases by 100 units, your mindset is right here in that second one where you had 900 units, and you might put 800 here. Go back to the original. So if our sales units drop, we're going back to the 1,000 units, subtracting the 100 units, and we've still got 900 units. Okay? So again, just a little bit of, perspective check on something like that. The other thing is they asked about the selling price increasing by $2 per unit. So I'm just going to come over here to the per unit. And again, I like to program in, so I'm just going to take that original $35 and add 2 to get to 37. At that point, to get to our sales, right, we just need number of units times the selling price. So now we've got 33,300 dollars. Then our variable cost is just simply the 900 times the $21 per unit. That has not changed. So now we've got a contribution margin of 14.4. And again, don't read anything else into it. Fixed expenses have not changed, so we're just going to pick up that 8,400 from the original. Easy enough. So then we start playing with more what ifs. Okay? And item number 7. They go on to say, if the variable cost per unit increases by $1, okay, spending on advertising increases by $1,900, and unit sales increase by 280 units, what would be the net operating income? So now we've got several things going on here. Now, I don't know which direction you want to attack it. whichever way you want to do it is totally fine. I'm always going to start with units. Okay? So I'm going to start with the original 1,000 units, and we ended up with an increase of 280 units. So I'm simply taking the 1,000 plus the 280. The variable expenses increased by $1. So again, I'm always going to hit the equals. I'm going to come back up here and pick up that $21 original and add $1. Part of the reason why I do that, by the way, is so that I can always track my logic. So it's like if you've got that in there, you've got it plugged in there, and then you're sitting there suddenly and you're like, oh, by yourself at home looking at it, you're like, where did I get that from? It's like, oh, well, I got it from the original plus whatever or minus whatever. And then you can track everything, okay? Then again, when we get our sales, we just simply take the number of units times the sales price. Variable cost is the number of units times the variable cost. So now we've got 16,640. I know what I did. Sorry, hang on. This is always one of those things. Okay, I'm going to have to get you to switch this for me. Right there. To follow this one correctly, it's an increase of 150 units. I forgot to change that when I changed my... There we go. All right, so it should be 1150. All right. Now, that 1900 really should be... I forgot to update this narrative up here. Sorry. That should be 1250. Yeah, should be 1250. There we go. There we go. So the increase in the advertising, that is actually going to sit down here in the fixed expenses. Now, keep in mind, when you're thinking about marketing dollars, if they gave you something along the lines of sales commissions increased by a certain dollar amount, best bet, that's going to be an increase in the variable expenses up here, right? But when we're just simply talking about, advertising, where we're putting ads into the newspaper, billboards, pop-ups on the internet, whatever it might be, all of that is going to be down here in fixed expenses, because none of that is going to actually be able to be specifically and directly tied to a specific product that's happening there, okay? All right. So now that I've actually got my yes. All right. Okay, so then they're asking about the break-even point in unit sales. Okay, now again, keep in mind that we're going back to the top, right? So we've got $8,400 that we've got to factor in. That is our fixed cost. And every time we sell a unit, we've got $14 towards that $8,400 that we earn, right? So when we've got a break even, we just simply need to know how many units times 14 is going to equal that fixed cost. So we simply come up here, pick up our fixed cost, and divide it by 14. And we get 600 break-even units. Okay? Now, what that means is that if we sell 600 units, we're going to have 0 profit right here in net operating income. Okay? All right, how we doing? At that point, they want break even in dollars, so we'd simply take the number of break even units and multiply it by, again, come back up here and pick up that $35 of original amount. So we're looking at $21,000. Okay. Then, so again, we need to know where is 0. Then it's a little bit like, if you ever think about this one, it's a little bit like you every year as a person when, I think they call it like tax freedom day for the average person is somewhere around like April, where it's like you've paid in all your taxes. So, you know, if you want to think about it, it's like every dollar that you've earned up until, you know, somewhere around mid-April, every bit of that goes to your taxes, and after that, it's like it's all yours. Okay, that's effectively what we're calculating here. All right. Then they ask about how many units must be sold to achieve a target profit of $8,400. All right. So in this one, not only do we need, we're just simply going to go how many units above that 0 to get to 8,400 as our net operating income. So on some level, you simply take that additional, we need that additional fixed expenses plus the 8,400. You with me? So we need to cover fixed expenses plus the additional profit and just simply divide that by the contribution margin per unit. So we've got 1,200 units to get to that point. We divided it by the $14 per unit from the original, right there. I tell you, the hardest thing to me in this foundational stuff is it's like, you know, we're chronological people, and we like, it's like whatever just came last, it's like let's build on that, and they don't do that. They are constantly going back up to the top. But the trick is here is that we're trying to cover fixed cost plus that profit. So in the same way that we figured out right here, the break even was a profit of, it's like we're covering the fixed expenses plus 0 profit. Here, we're covering fixed expenses plus profit. Okay? All right. Let's look at number 11. What is the margin of safety in dollars, and what is the margin of safety percentage? Well, the current sales is the $35,000. Okay. The break even hang on one second. Dadgummit. I didn't update that one either. The break even is not that 860. It's 600. So the break-even sales at 600 is the 21,000, and the difference between the two is our margin of safety. So effectively, at that point, we've got, if we're trying to give ourselves an idea of, if sales drop, how badly is it going to be before we hit 0? So in this particular case, it's 14,000. Now, if you stop and think about that, we've got 35,000 here, we got 14,000 there. So when we're trying to factor in our margin of safety, right, we just simply take our margin of safety and divide it by I think we need to go back there see, again, I made a bunch. Yeah, we got to go back to the 35,000. So, sorry, I need to work on this one. Is actually I'm editing somebody else's work. I'm just missing some of the details here. I'm just going to put original. Okay. So if we need a percentage, right, we just simply divide the 14 by the 35. So we've got a margin of safety of 40%. That's actually not bad, right? Sales would have to drop by 40% before we have a real problem, before we go negative. That's pretty good. If that was like 3%, it's like, ooh, that would be a problem. Okay? How we doing?
So I'm struggling with like the break-even sales.
Mm-hmm.
Because the break-even point in dollar sales would be put in 21,000, which is equivalent to the original variable expenses. And is that because we're just gonna incur the fixed expenses regardless?
The 21,000. Just realize that our break-even. When we're looking at what is the degree of operating leverage, right? We're effectively looking at the contribution margin and the ratio between the contribution margin and the net operating income. So if we come up here and we grab that contribution margin of 14 and we pick up that net operating income number of 5,600 and we simply take the 14 divided by the 5,600, we get an operating leverage in this particular case of 2.5, which basically means that every time we've got a percent increase in the contribution margin, a percent increase in the net operating income, we're going to have 2.5 times the increase in the contribution margin. So it just this operating leverage item just gives us the ability to quickly take some numbers and figure out, it's like, okay, if contribution margin goes up by X amount, what's going to be the effect on the net operating income, or vice versa? Okay. Now, I would imagine that this whole degree of operating leverage, that one, let me just tell you, if you get to your, again, I think I told a bunch of you this in 120, so if you don't remember it, I'm going to repeat it. When you get to your senior level paper, and you're going to have to do, like this 50-page paper, this is one of those items where when you start talking about operating leverage, you throw that one in there, I promise you, it's like you're going to get an A on that paper, right? All these ratios that we went over in 120, all these ratios and analysis and everything that we go over in here, it's like that's what they're really sort of bringing to bear in your strategy class when you get to your senior level. And this is one of those that it would be really good to address, is this operating leverage. And again, this operating leverage, the more fixed expenses you have, the higher this operating leverage goes, because your net operating income drops significantly more, which then, when your denominator gets smaller, right, that increases your ratio pretty substantially. So it is interesting to see, I think one of the examples that they used in the book was, could not remember the name of this company, but they were talking about the online grocer that it's like this first online grocer that came onto the scene and everything. It's like they thought they were going to kill it with this business model of very highly automated robotics, highly computerized and everything else. That's great, but the problem is that when you've got that much fixed cost, that means you just have to be making that much more in your contribution margin to cover all those fixed costs. So, no, you don't have to hire as many people, but it does change that operating leverage. So just think, higher fixed costs, higher leverage, you got to work just that much harder to make sure that you don't end up in the red. Okay. Number 13 says use the degree of operating leverage. What is the estimated percent increase in net operating income of a 5% increase in sales? A 5% increase in sales should result in 35.7% increase in net operating income computed as follows. All right, so the degree of our operating leverage, right, we got a 2.5. Okay, we've got a 5% increase. So we just simply take the multiplier of those. So if we've got a 5% increase in sales, we're going to end up with a 12.5% increase in net operating income. Okay. So some of the interesting things that you can play with there, and again, we'll keep looking at that one because there's another problem that's got an operating leverage question on it as well. All right, so keep moving. All right, so assume that the amounts of the company's total variable expenses and total fixed expenses were reversed. All right, now again, let's again, big picture view. We're reversing the 21,000 and the 8,400. So understand what's really happening bottom line. Nothing's changing down here. We're still going to end up with net operating income of $5,600, right? But we're simply flipping these two numbers right here in total. So, in other words, assume that the total variable expenses are 8,400 and the fixed expenses are 21,000, right? So then they're asking about, under this scenario and assuming that total sales remain the same, what is, what is the degree of the operating leverage, right? So we still take our contribution margin. So notice what happens to our contribution margin. Again, nothing's changed down here in net operating income, but our contribution margin has gotten much larger because our variable expenses are so much lower. Our net operating income, right, is the 5,600, and then that means we end up with an operating leverage of 4.75. Now again, I want you to think about what would cause this, because again, otherwise it's just a math problem, okay? And we're not doing math, we're doing accounting. So in the original version, think about, I'll give you for instance, they used an example in your book, and I'm trying to remember, the blueberry farm. Did you read some of those little things down there in the little exhibits? I just know that I did the same thing when I was in school. Okay, it was like the only thing I was going to read was the pieces of the chapter that were, actually the part that I had to read, and I wasn't going to read anything else. I get that. But there was one of the examples that they had in there that was actually very informative, and I think gave you a real sense of what they're talking about here. Was they had an example of two blueberry farms. One blueberry farm hired all kinds of people to come in and pick their blueberries. Okay? So when those folks came in and picked the blueberries, their expense would be up here under variable expenses. They come in temporarily, they pick all the blueberries. When the blueberries are picked, they go home, right? So all of their expense would be up here in the variable cost. And then, you know, at that point, you've got minimal, call it equipment and machinery that has to get involved in picking the blueberries, right? So your fixed costs are much lower, right? Versus if we've got a situation like this where all of this is flipped, the example that they gave you was that on the variable expenses, they had very few people that came in and helped pick blueberries, because what this other blueberry farm had done is they had highly mechanized all of their blueberry picking. So they had all this large machinery and everything that would literally go out there and, you know, like shake the vines and everything to get the blueberries off, right? But you have to remember that equipment is still sitting there year round. You with me? And is considered a fixed expense, but it's a very expensive fixed expense. So even initially, when, you know, that company, they bought all the machinery and everything to help pick the blueberries, when things go well, because of this high degree of leverage, when things go really well and they have more sales than they anticipate, because of this ratio being higher, this leverage ratio, they make a disproportionate amount of income, operating income, okay? Because they're still using the same amount of machineries, just harvesting more blueberries and selling more blueberries, right? Well, again, the harvesting machinery is still down here in this 21,000. That first blueberry farm, if they end up having a bumper crop of blueberries and can sell a whole lot more blueberries, remember, their variable expenses are going to go up disproportionately, because now we're going to have to hire a disproportionate number of people to pick the blueberries. Does that make sense? Go back and look at that description of that story. It was actually really good to help you see the difference between them. So these highly mechanized businesses, you're talking about something that looks like this. Okay? They've got a high degree of leverage, but they've got high fixed expenses because all that machinery is there 24/7, 365. It never goes home. A lower leveraged situation would look more like this, where again, if we have a bumper crop one year, no problem. We hire more people, but after the harvest is done, they go home, right? But it disproportionately increases our variable expenses, but it also increases our sales, okay? So highly mechanized businesses, there's definitely a balance, because again, the more fixed cost you have, when sales increase, it looks great. But stop and think. That highly leveraged model works in the opposite direction when things go bad. So like the blueberry farm. Let's say that one year they've got a tornado, they've got, who knows, a tornado, too much rain, a bunch of the blueberries ended up with mold. I mean, all kinds of stuff, right, is happening in farming. But when you've got that kind of situation, you've got low mechanization, and the number of blueberries on the vines are much, much smaller, not a problem. We just don't hire as many people that year. But the folks who have the highly mechanized farm are going to have a disproportionate loss. So those disproportionate gains when things are going well works in the opposite direction of disproportionate losses when things get bad. Okay? So leverage works well when things are good. It's a whole different story when things go south. Okay? So it can speed up the decline of a business when things start to turn. So you've got to... Have y'all studied the life cycle of a product yet? Did y'all do that in maybe a Business 110 or possibly even a 137? Have y'all done that yet? Okay. Life cycle of products, right? You've got this initial phase where everything you come in and everything's going pretty well, and then if things actually catch on, it's like you end up with this huge incline of how well things are going, and then it sort of arcs out, and they call it the cash cow phase, where it's like profitability and everything else are going well, and then after it sort of arcs out and everything starts declining again, then it's that you've got to be able to, same kind of thing here, you've got to be able to anticipate that decline and figure out what are you going to do next. Another example that they gave you in the book, this was actually a pretty good chapter. One of the examples that they gave you in the book on that sort of type of thing, they didn't really go into the whole life cycle thing, but was Microsoft. So if you remember, well, y'all probably don't remember. So when Microsoft Office first came out, right, and you bought a computer, right, the software was already loaded on the computer. That was it. That was the deal. It was like that was your license. You had the software on the computer. And then when the internet, and they actually used to buy it on actual, 3.5-inch discs, and possibly loaded on your computer. And then when the internet came on board, then they kind of went to a model of you could buy it with, at that point it was probably like CDs that you could use to download onto your computer, or you could download it off the internet, just depending on whether your internet speed was fast or slow. But one of the things that happened there with internet is the amount of highly leveraged internet technology infiltrated the market, and Microsoft started doing everything from the cloud, right? Which then meant that they had to have all the storage and everything else on their end for you to use the product. And now they went through the whole process in the book of going through how Microsoft has really changed their business model from that type of model where you were buying it and it was loaded on your computer to cloud-based services to really maximize their income. So go back and read those little examples and everything that were in this chapter. They were really good examples. All right, let's look at number 15. So assume that the amounts of the company's total variable expenses and total fixed expenses were reversed. In other words, assuming that the total variable expenses are $8,400 and the total fixed expenses are $21,000. So again, we're dealing with this scenario right here. Using the degree of calculated operating leverage, what is the estimated percent increase in net operating income? See, I didn't give myself enough room there, of a 5% increase in sales. Okay. So again, we're dealing with, so this one gave us a 5% increase in sales, gave us a 12.5% increase in net operating income. This one, right, is going to give us 4.75. So against the 5%. So again, that works well. And that looks really good. But again, remember that, let's pretend that that is, or pretend that that is a negative 5% decrease in sales. Now we've got a negative 23.75% decrease in net operating income. So again, you've got to balance this whole thing of variable versus fixed expenses. And totally fixed expenses can be quite catastrophic if you're not careful. On an upswing, when your product is on the new phase, and then the maturing phase, and then the cash cow phase, all that could be great. But when you hit that downside, it can go fast, and it will go faster than you can possibly imagine. So just some things to think about. I mean, unfortunately, business is brutal just because it's like the economics of it and the accounting of it and everything else just can get, it's like trying to fight gravity. All right. Okay. Let's take a look at exercise 5-2. All right, so we've got Worley Corporation's contribution format income statement for the most recent month is shown below. All right, so they gave us all the stuff that's filled in. Okay, the only thing that they didn't give us was the percent. Okay, now all we've got to do here, again, is if we want the percentage, remember that sales percent is always 100%. The percent for the variable expenses is just simply that divided by sales, right? And then our contribution margin percent is just the difference between the two. Okay? And again, it's not a bad thing to just stop and think. It's like, are those percentages adding back up to 100%? Okay? All right, so let's look. What would be the revised net operating income per month if the sales volume increases by 70 units? Well, if we just simply take the original 7,400 units, add another 70 units. I left the formulas in there for you because at that point it's just simply the 7,470 times the sales price per unit, the 7,470 times the variable cost per unit. Then we back out the original fixed expenses, which didn't change. Okay. All right. Then they ask you what will be the revised net income per month if sales volume decreases by 70 units. Okay, well, let's just go ahead and let's pick up the original 7,400 units and let's subtract the original 70 units. So that's what happens. The first one is going up by 70 units. The second one is going down by 70 units. Okay, nothing huge there. Okay, what would be the revised net operating income per month if the sales volume is 6,400 units? So now they just simply changed it to 6,400 units. Once you key in that number of units, again, I think at this point you can see that the math is not that difficult. Okay, how are we doing on that one? That one's actually pretty easy, right? Let's skip over to 5-3. We're sort of, if you notice, what we tried to do in the order in which all of these questions are presented in the practice is we're starting with the earlier learning objectives and we're building and then combining them all together as they become more complicated. So hopefully it sort of gets your logic going in the earlier questions before you get to the more complicated ones. All right. So then at this one, right, we're given several different items of information, and then they ask, what is the company's degree of operating leverage? Well, again, we're simply going to pick up the contribution margin. We're going to pick up the net operating income, and we're going to divide it. So 4.29. Let me just say that this is the kind of thing where, again, remember all of these statistics, ratios, and everything else. They need to be analyzed within context as to the different areas of the industry, like whether it's pharmaceuticals versus technology, that kind of stuff. So make sure that any ratio analysis is done within context, as you're taking this forward to a different class. All right. Then it says, using the degree of operating leverage, estimate the impact on net operating income of a 6% increase in unit sales. Well, so we pick up the operating leverage, 4.29. We will need a 6% increase in sales. And again, we're just simply going to multiply those together. So we get 25.71%. So on a 6.1% increase in sales, we get a fairly significant increase in net operating income. Okay. All right, number 3. It says, construct a new contribution format income statement for the company, assuming a 6% increase in unit sales. Well, all I'm going to do is I'm going to come down here to the units. I'm going to hit the equal sign. I'm going to come up here and I'm going to pick up that $1,000, and I'm just simply going to multiply by 1.06. So that gets me to my 1,060 units. The sales price per unit hasn't changed. The variable expenses have not changed. The fixed expenses have not changed.
That was satisfying. Seeing it all go out immediately.
All I'm saying is, I'm telling you, I realize that we don't do this kind of stuff in ACC120. In ACC120, though, we don't have, probably about the equivalent would just be the simple fact that sometimes in some of the problems and things, you can fill in the journal entry and it automatically posts into the general ledger. That's about as good as we get, in 120. But I'm just telling you, Excel is a phenomenal partner for accountants. Because again, you wouldn't want to have to do all this stuff. Trust me on this one, because I was in an accounting program before, it was before Excel. It was actually called, Excel was called 123 back in the day. It was 5 1/4 inch floppy disks. That was interesting. Okay. All right. Let's look at exercise 5-4. Okay. So on exercise 5-4, we've got Morrow Products sells a woven basket. Let's make that a little bit bigger. A woven basket for $13 per unit. Its variable expense is $10 per unit, and the company's monthly fixed expense is $8,100. All right. So again, all we're doing is, they gave it to you in narrative format. I gave you a place because again, if you can capture the relevant data and everything, then all we have to do is just point to the cells and just use it as we need to. So if we're selling for the $13, right, the sales dollars per unit is just 13. The variable expense per unit is 10. Now we just need to take the difference between the two, 13 minus the 10, and now to get the percentages, because that's where we're going to go. We're going to have to get those percentages eventually. So we get 100%. Then we take the 10, divide that by the 13. That gives us 77%. And then you can do this one of two ways, right? We could take the 3 divided by the 13. That'd be another way to do it. But again, always make sure that your totals add up to 100%. And your fixed cost is $8,100. So there's all the data that we need that we want to use to program our spreadsheet. So then it says, calculate the company's break-even point in unit sales. All right, you remember how to do it? Good. It's the total fixed cost of the 8,100, and we're going to divide, and remember, we're doing units, so we're going to divide that by the contribution margin dollars per unit. So we get 2,700 units. Then we want the break-even point in dollar sales. Now, all I'm saying is that it's like I'm just simply going to take the 2,700 and multiply that by the 13. Okay. All right. Now think about what's happening here. It says if the company's fixed expenses increase by $600, all right, so let's come down here to the fixed expenses. We're going to start with the 8,100. We're going to add the 600 to it. What would become the new break-even point in unit sales? Well, again, we could just simply take, pull all, we can simply pull all this down. And depending on whether you want that line there or not is up to you. So, because once you notice the line's there before, but then once I pull that down, the line goes away because again, it's using the formatting for that cell. Okay. So at that point, the break-even point in unit sales, again, is just simply, now we've got to take the 8,700 and divide by that $3 per unit. So now we need to sell 2,900 units. So don't miss this. Don't make it into a math problem. Stop and think about what just happened there. So we increased our fixed cost by $600, which then means that we've got to increase our sales units from 2,700 to 2,900. Now, if we think that we can increase our sales from 2,700 units to 2,900 units, then okay, we might be in good shape. So then 2,900 times 13, there is our 3,770 for our break-even point in sales dollars. Now you can sort of play with it. So think about what might happen here. What if we increased, I'm going to play with it here for just a second and then back it up. But let's say that we increased our fixed expenses. Maybe we were just trying to think about, well, what happens if we go to a more mechanized production system that would be on 24/7, which then meant that our fixed expenses go up to $15,000. So now we've basically doubled our fixed cost. We're going from 2,700 units to 5,000 units. If we think we can do it, I mean, that's quite a jump in sales. You see where I'm going there? That's quite a substantial increase in the number of units that we're going to have to sell. But if we think that we can do it and we got a plan to do it, then okay, maybe we ought to do it. But love you marketing folks and everything, but marketing, just be real. Marketing folks will tell you, oh, we could totally do that. But is that really realistic? Marketing people have a tendency to what's the word I'm looking for? They're overly optimistic sometimes. Let's put it that way. They're overly optimistic sometimes to the point where, and we accountants are always the one that everybody says, oh, you're just trying to rain on our parade. And it's like, no, we just don't want to shut the doors, right? We want to keep everybody in business. We want to keep everybody with jobs, right? But you get how that's working? All right. Let's go over here to 5.5. All right, so now, again, we're looking at that margin of safety. Okay, so again, in this particular one, we've got to go at it. They don't give you the whole entire thing, income statement. So let's play with it a little bit. All right. So the first thing that we've got to do is we've got to come up with the current net operating income, right? So we've got to get sales. So in this case, the distributor of a sun umbrella used at resort hotels. Data concerning the next month's budget appear below. All right, so we got 990 units. So let's pick up the 990 units. Oop, I actually dropped it in right there. Right, multiply that by the sales price. And then on our variable expenses, the 990 times the variable cost per unit of 14. And again, our fixed cost is still that 12.6. All right. So we've got, right now, we've got 990 units and we've got $2,250 in net operating income. Okay. So what's the break-even point in unit sales? Well, remember, we're simply trying to cover fixed costs with 0 net operating income. So we simply take those fixed costs, divide that by the contribution margin dollars, right? And we've got 840 units. Okay. Then we've got to read, and let me say this, we don't have to, but again, I am always trust but verify, okay? So in this next one, I give you the opportunity to put in the 840 units and then rebuild that income statement. So 840 units times the $29 per unit gets used as sales. The variable expenses are the 840 times the 14 per unit. Our fixed costs are 12.6, and there's our net operating income of 0. So that's where we were looking at it before, where you can stop right there and take a look at the two different scenarios where we've got 990 units and then the 840 units with a 0 net operating income. So there's the break-even point in units, and then they ask, what's the margin of safety in dollars? So again, the current sales is the 28,710. The break-even sales are the 24,360, and our margin of safety is just the difference between the two. Okay. Then they want margin of safety as a percent of sales. So again, the margin of safety is the 4350. The total current sales is the 28,710. Whoop. And just simply divide those together. Hang on. To get a percent. Now, how are these folks doing as far as their margin of safety? Context matters, yes, I get it. But, well, they're making money, but if we end up with a 15% reduction in sales, we're going to end up with 0 net operating income. Now again, remember, net operating income is not the stopping point on that income statement. That's why I was trying to really get you to think through that when we first started class. Because remember, net operating income, we still have additional cost after that. Remember, net operating income, that is everything that is what we do at the core of our business, but there's all kinds of other stuff that could be down below there that's non-operating income, like interest expense. You with me? So if we've got something along the lines of a 15% margin of safety, That's okay. I'd like to see more. Now, if we were this company in March of 2020, the year we will all remember, the March we will all remember, right? As long as we live, COVID hit. If you were a restaurant and you had a margin of safety of 15%, how are you doing in May? Not well at all. Right? Because that was one of those where it's like, no, well, you know, those folks who live in dark rooms in the basements of, you know, think tanks and stuff like that, you know, probably were sitting around going, yeah, we figured that pandemic thing was just a matter of time. But in March of 2020, sales for a lot of companies absolutely went off a cliff, right? So a 15% margin of safety, that wasn't going to save you. Not in a scenario like that. I don't know that you can manage your business trying to build your, how can I say this? I don't know that you can manage your business necessarily on a margin of safety in anticipation of something like that, because when your sales drop to zero, it doesn't matter. Zero sales is zero sales, right? But what you do is you manage massively for profitability and cash flow in the years leading up to possible things that are happening like that. And then when something really horrible happens, you basically live off your savings. Okay? And you keep your business going if you think that it's viable, you know, beyond the pandemic. So just kind of some of those sorts of things to think about.